For more context about the markets, I'm joined by Anil Gupta. He's a global strategy expert and a professor at the University of Maryland. Anil, welcome.
Pleasure.
All week, experts have been trying to figure out what is going on with global financial markets. Let's begin with China. The Shenzhen deposit for the fifth consecutive session down again on Wednesday, although not as bad as we've seen. What do you make of it? What is going on?
Yeah, I think, if you look at the Shanghai Composite, so it's currently around 2,900 or so. And essentially, the way I see is that about 2,600, I see as the low point. So obviously, it had gone up to 5,100, which was, completely wild. And so, that froth had to come out.
So you see this as a correction?
Oh, I mean, absolutely. In terms of China, I see this absolutely as a correction. And I think there is still some more room for correction to take place. But I think bulk of it is out of the way. And I expect, that the Shanghai Composite probably to kind of hover between or vary between 2,500 and 3,000 for the coming future.
And the Chinese central bank has taken a number of steps to stabilize the stock market, to shore up the economy. Do you think these measures are working?
No. I mean, certainly intervention in the capital markets has not worked. Excuse me, and it was not expected to work, so that's not surprising. I think the cut in the interest rates, the cut in the reserve requirements that took place, that were announced yesterday morning, I think those are good. But again, the effect will be limited because what it does is that it pumps more money. More than 600 billion yuan, more than 100 billion US dollars into the Chinese economy, or at least, let's say, it makes that money available to the banks to lend. But the question is, being willing to lend and having the money to lend is not the same thing as people willing to borrow. And if we look at, all the state-owned enterprises, which are in steel and cement and glass and heavy machinery and automotive, these are not the industries where we would expect companies wanting to borrow. And on the consumer side, I think still, companies are going to be a little bit shy because they're a bit scared of where the Chinese economy is headed in terms of the growth rates. So I think the problem is not having the money to lend, but really the willingness to borrow.
Well, talk about the Chinese economy and the stock market. They're not necessarily connected here. You can have volatility on the stock market, and your fundamentals in the economy can still be strong. The GDP, employment rate.
Oh, yes. And in fact, I mean, in the long term, whether it is China or US or Germany or Japan, in the long term, there is a positive correlation, has to be a positive correlation between the health of the economy, the growth rate of the economy, and what happens in the capital markets. But in the short term, the two can be completely out of sync. In the case of China, there is something else that has been going on for the last 20, 30 years, which is that if you look at bulk of the companies that make up the market cap on the Chinese exchanges, particularly the Shanghai Composite or the Shanghai Stock Exchange, those are the state-owned enterprises. And those state-owned enterprises, their goal has not been profit maximization. It has not been earnings per share maximization. They essentially have been arms of the government, and their goal has been to invest, and in fact, overinvest in infrastructure and related industries. And so therefore, if the bulk of the companies that are listed on the Shanghai Stock Exchange, if their goal is not to actually maximize earnings, but their goal is to invest for the health of the Chinese economy, then the Chinese economy may continue to do very well, as it did for the last 30 years. But it doesn't necessarily mean that earnings pictures would look very good or that the stock market would do well. And that is what happened in China.
So Anil, how do you get confidence back among these young investors, young investors in China who may not necessarily have that much experience? And a lot of them have sort of, lost their confidence in the stock market, and they don't want to invest, or they've lost their life savings. And there's not that many of them compared to the population of China, of course, when we're talking about. But how do you get that confidence back?
Yeah, I mean, if you look at just, and not just China, but if you look at economies around the world, that once retail investors get scared and they lose confidence, that confidence comes back, but it takes fairly long period of time. So you could lose the confidence in 6 months or 3 months, but it might take 5 years for that confidence to come back. So I think the retail investors would take quite some time. And by quite some time, I'm talking about a few years for that confidence to come back. Institutional investors are a completely different story.
And finally, do you expect this type of volatility to continue, not just in China, in Europe, in the United States, in some time to come?
Oh, actually, I see volatility, not this kind of volatility that we have seen over the last 2-3 months, but I expect to see volatility to be pretty much a permanent feature of the global economy. And the reason for that has nothing to do with China or the US or any other economy as such, but it really has to do with the world economy has become more and more tightly coupled, and it's becoming more multipolar. So you create any system where you have the nodes are getting to be almost as big as each other, and they're more and more tightly connected. You will have
the domino effect.
You'll have the domino effect because turbulence in any part of the global economy now actually kind of ripples through the entire world economy very rapidly.
Fascinating discussion. I always learn something. Thank you so much,
Pleasure.
Anil
Thank
Gupta.
you very much.